We're a few minutes late. I do apologize. This evening here, I wanted to get together and talk about raising capital. So we're doing these video series to really house them on our YouTube channel and to also discuss questions that we get asked a lot, things that are hot topics right now. We want to be sharing what we are learning and feeling about these things, and also just spark conversation and be able to open a platform if there's conversation that is to be had. So if you're watching this and you have comments or feedback, please send them. I would love to hear what questions you guys have. We're going to cover kind of this topic as based on the things I get asked a lot, but please, by all means, if there's something that's very, valuable to you that would be helpful, let me know. Before we get started, just to briefly introduce us, my name is Natasha Phipps. My partner Rodney Phipps is here this evening as well from WealthShare, and we are two of the five co-founders of WealthShare, and we are a private REIT located here in Calgary. Previous to that, my husband Rodney and I have done other projects that required raising capital, and I have helped a lot of clients in this space as well put together, deals that make sense for both parties in these types of transactions. So I think there's a lot that we could cover tonight. But before we do that, I do need to quickly do the boring thing with WealthShare. We are a highly regulated structure, and as a result, we do need to provide a disclaimer that anything we do discuss tonight is not, legal advice. I'm not a lawyer. I'm not an accountant. Just sharing what we have, learned along the way, and this is for educational purposes only this evening. If you want to receive this full disclaimer for your viewing pleasure, you can go to wealthshare.ca to review the entire thing in detail should you want to. So before, I'm going to get to our offering later, but this is kind of the quick overview of the things I thought we could cover this evening when it comes to the topic of raising capital. And I think there is a lot of hot topics when it comes to raising capital, and I think a lot of things are getting blended together out there in this space. So I want to make a few things clear here as we review this. So number one is, why do people get into raising capital? And my background and career is as a real estate investment focused realtor. And we all run out of money typically at some point, is usually what happens, where, we can only get so many mortgages, or we only have so much capital and we want to continue to grow. That's traditionally the most common paths I hear about when people want to start looking at raising capital, is they want to expand their portfolio, but they might be restricted by the means that they have themselves. So that's absolutely, very common pathway. There's also pathways which are becoming more popular right now, which I really want to address, where people might be brand new into real estate and are learning about, going directly into raising capital right away. Or common term, which I don't love this term, is OPM, or other people's money. And that's another way people are getting into raising capital. What I wanted to talk about before we even talk about raising capital is, where should we be starting as an individual or a group or company who wants to raise capital? And the most important step here is to start with your team, start with your legal team, start with your accounting team, because I don't think enough time is being spent, maybe at the very beginning sometimes, in learning about the different structure types, how you can protect yourself, how you can protect your investors. And you need to really be okay to be spending a bit of time and money here at the very beginning, and starting with that team that's going to be your kind of power team when it comes to putting these types of opportunities together. So I see it often happening the other way around, where people are maybe getting that advice later down the road. But if you're serious about doing this and serious about raising capital, this is where you should start, in my opinion. You should be getting that advice right out of the gate. The third thing is, this is where I want to draw a huge line in kind of our minds, if we could, about the different types of raising capital. They fall into two different, funnels, let's say. One is passive investments and one is private lending. And these are not the same thing. ultimately they will raise capital, but they are two very different things. So private lending is something we're all very familiar with. Very commonly in our community and world, there's peer-to-peer private lending. There's, secured and unsecured in that area, which could mean, unsecured promissory notes, which are quite high risk. There's no security for the investor. And then there's also a more secure type of private lending, like a private mortgage, where you could actually register the debt against title of some sort of asset that the borrower may have. So those are private lending type of examples. Passive investments are more when you're getting into private securities. So WealthShare, for example, as a private REIT, when you invest with WealthShare, you are investing in units and you're acquiring trust units into the structure. That could also mean shares in a company or limited partnership units. And those passive investments are a type of private security. And that is all regulated. And I think they're kind of being mismatched. And I think there is a lot of, press out there and kind of difficult stories when it comes to the, promissory note world. But there's a lot to be learned from that. And the funny thing about this too is, like, a few years ago, it was all about joint ventures. Everyone was doing joint ventures. We were doing joint ventures, and it seems like these things do come and go in trends. And that's okay too. Things come and go, and that's just the way it is. But just be aware that doesn't mean that the previous trends aren't valuable. So let's talk about joint ventures, because I think these are a great way, if you are new to raising capital, to do your first deal, potentially provide security for your investor, and ideally come to the table with a partner who maybe has opposite resources or opposite skills as you. The real estate investing game is, trying at times, and having a partner is a really nice way to get into it. So, typical joint ventures, often you have your working partner and your financial partner, and each of them has their set roles and their set contributions, and it should be outlined by your team of what this agreement is going to look like. And this is a very good way to raise capital, to possibly bring other skills that you might have, like if you're a contractor, or you're really good at finding deals, or you want to manage a project, whatever it might be, you can bring your skills to the forefront and offer a secure way to raise capital. So we talked about the first step of getting advice. Now, I cannot stress this enough, because if you're looking at the different types of investments here we're talking about, if it's a passive investment, often when people are getting into these passive investments, like limited partnerships, corporate structures, they're often needing more than one partner, or they're doing larger types of transactions. So a joint venture or just a private mortgage on a property work very well for a single family home, or even like duplex, a smaller type of property. Usually when people are getting into the larger transactions, like multifamily real estate, large developments, they are then starting to create a passive investment where you're needing to pool a larger number of investors' capital. So you may have, 10 investors investing $100,000 each or $250,000 each. But it's really important, when you get this advice, that that's the conversation you're having with your team. To sit down with your lawyer and discuss the size of the project, and then they will best advise you on the type of structure that makes the most sense for what you're looking to do. Setup costs are going to be very different than, just doing a simple promissory note. It is very little cost, very simple. Doing a private mortgage, a lawyer or a mortgage broker can help you do that, and the costs are pretty minimal. So you can get started in this raising capital space, even in a secure way, by not spending a substantial amount of money. If you go up into these passive investments, of course, now you're talking about more complicated legal structures. And so that advice you might get might be a little bit more costly and in-depth, because there's just a lot more variables to consider. But that money is really well spent. You cannot stress enough how good the kind of value of the advice can be when you don't know what you don't know yet. And also, things are always changing. So get some good advice. some structural ideas. And I think, like I said, these things go in waves. We've talked about how joint ventures were like hugely popular several years ago. And then it was the LPGP. Everybody was setting up an LPGP, which, you know, has its benefits for sure. And then now everyone is setting up a mutual fund trust, and those are very common now. 2-3 years ago, no one knew what a mutual fund trust was. And these structures have their benefits, their pros and cons. Mutual fund trusts, for example, given they're highly regulated and there's a lot of reporting that you have to do, they're very expensive to run. You combine that with an offering memorandum that has to be updated annually, financial audits. You know, the maintenance expenses alone are in the tens and tens and tens of thousands of dollars a year. So you wouldn't want to set that up for a simple, you know, duplex to fourplex, you know, project. What you would want to set that up for is a large and growing portfolio, or possibly a large development that you're doing. So that's where the advice is really, really important in raising capital. And I go to a lot of these kind of like pitch type sessions, and often the individual raising capital is, you know, could very well have a great project, have a very good, you know, opportunity in front of them. But if all of this isn't set up and I'm ready to invest and I go, okay, you know, show me the paperwork, or what does the documents look like, or what does our agreement look like, and none of that is prepared, you lose your momentum with the investor, right? And then you're kind of taking the steps backwards. So I highly suggest, you know, get the structure set up first, and then go find your money. You have everything ready to go. You have the, you know, structure in place, because really, if you're going to raise capital, you should be doing that. You should be, you know, getting that set up out the gate. Rodney, are you going to say something?
Yeah, I was just going to add to that. It's like one of those things that you know, it's these sayings that you have, your first impression, right? You only get one first impression often with somebody. And if your first impression is, I got this great thing, great, great. Well, how do I invest? And then it stalls. Well, how much, you know, goodwill is that really going to buy you with somebody, right? Like if you come back later, it's like that elevator pitch. I mean, business school 20 years ago, we go over this elevator pitch. The first thing that you do when you're building out a business plan. It's no different when you're investing in real estate. It shouldn't be. And so you only really have that one sort of chance to get in front of people the first time. And then if you're not all the way prepared, you're really putting yourself behind the eight ball a little bit. And then just also with that, like, I don't think that either of us can say it enough times, having the right people around you, surrounding yourself with the right team, getting the right advice, it is invaluable. Having the right structure for the right deal, but also having the right professionals that you're working with to help you set up those things, that have some experience, that understand the different structures and the different reasons for them. Having a few heads looking at what you're doing, it's so vital at the beginning, because you, like I said, you only have that one chance to get in front of somebody. If you're not surrounded by the right people, and you haven't presented the thing in the right place, in the right way in the first place, you know, you're toast.
Yeah, absolutely. And you know, you're never going to be all things to all people.
Yeah.
Well, I think that is a really critical lesson. You know, and something now that we're like really leaning into, like, this is who we are, this is what we're good at. And the more we're doing it, the more confidence I think that's building, and that this is what we know and this is what we want to master before we move on to other things. And so some like key lessons around what investors look for. They will invest with you, and this is like the number one lesson in like raising capital, is they will invest with you, number one, because they trust you and they like you. We can talk about structure all we want, and all those things are very important, but they need to have that trust with you, that bond built with you, which comes from being confident on what you're speaking on, being passionate as well, but really being prepared and being honest with what the plan is. So key lesson really is that building that trust, and people will invest with you because they like you. I've heard that time and time and time again. Natasha, all this is great, love it, love the project, but I'm investing because I like you. And that's really, you know, a really good lesson.
Trust.
Yeah, and the trust, and that's a really good lesson too when you're speaking to people, because sometimes, you know, especially when we're maybe a little bit nervous, we can start kind of, you know, going on and on about specifics and details and things, and all of that will come, but your time really should be number one, determining what the individual is looking for. Like, what is their strategic goals?
That's exactly what I was going to say,
Yeah.
because it's like everybody knows that what they're doing, they love it. They know why they're doing it, but why is the other person, what's in it for the other person? What is in it for the investor? Why should the investor care? Not why should you care? Everybody in the room knows why you care. It's your project, it's your passion, it's your everything. But why should the investor, what is in it for the other person? What is in it for the other person sitting across from you that you're trying to commit their funds to, right?
Mm-hmm. Yeah, absolutely. And if you ask those questions, and what that investor is looking for does not align with, what you're doing, maybe it's the timeline that you need. We're like long-term buy and hold over here at WealthShare. So if anyone tells me, what, I need in and out in 18 months, like, we're not it. And that's okay. And so just be honest about that too, because that builds trust. And it also, is, you want to be mindful of your time and making sure that this makes sense for you, but you're not going to be all things to all people. And you will find your people that align with your vision, just by getting out there and talking to people. So really aligning on that. I thought from here, key lessons and what people ask, I think, is something people are concerned about too when they get into the raising capital space. Like, oh my goodness, what are people going to ask me? And this is another key lesson, is if you don't know the answer to something, that's okay. Don't be worried about that. And I think that's something a lot of people are worried about to get in these conversations. They don't know the answer. It's much better to say, I don't know, but I'll get back to you on that. Or I need to check with my team on that. So be confident in what you don't know, as well as what you do know. That's a really key lesson as well, especially for like me. I mean, I like to know the answers. I like to make sure I'm prepared. But now I confidently say, like, I don't know, I'm so sorry, but we'll find out. And someone on our team definitely does know. And that's why you have your lawyer ready, your accountant ready, your team is already there for you, and they know what you're doing, and they can step in and support you on the things that you don't know.
Yeah, exactly.
Because some people have questions that are like, well beyond what I would have thought of. And we actually love that, because now I can go, get prepared for that the next time. I'm skipping forward here. So what I want to talk about briefly here, because many of the investors here, or that are going to be watching this, have already actively invested in real estate often before they go and raise capital. So in active investing, people know how to do their due diligence. They know what questions to ask. They have that confidence. And all of this can be applied directly to raising capital. Whether you are even the investor side, you're like investing passive in real estate, or you're raising capital, because this is what's going to prepare you on the raising capital side. So knowing how to, actively do your due diligence on properties, these are the types of questions people are going to ask you. And some people ask much more, in-depth questions than others, but usually questions are related to the project and the real estate, or the structure. How is my money secure? More like technical questions to do with the investment. So those are the two main buckets that I hear about. And also, who you are. So questions around that often do get asked about your experience. And to tie that into with your team, if you are, short on experience in certain things, showcase who you have brought into your team to fill that void. Because again, you can't be all things and wear all the hats. So who is your contractor, for example? Who is on your team to fill those gaps that you might have? Finding your niche as well is something when you're raising capital, I think, is really, really important, because I'm guilty of this as too. As real estate investors, we get excited about all kinds of things, and everything looks, like, oh, I could try that. I could try that. But the cool thing about raising capital is the more you repeat something, and the more of kind of a portfolio of work you have, and the more references you have, the more referrals you can provide, it's only going to get easier for you. And then the reality is also your investors will keep investing with you, because they know that you've like nailed down your niche, which is a huge thing. So like, I'm not an expert in, storage lockers and would never consider myself to be that. So if I just pivoted and went to there, I would need to find someone who is, because I don't have that experience. So find your niche, own your niche, and get really good at it. And then people are going to be much more likely to invest with you and continue. Knowing your unique value when you are raising capital as well, like what do you bring to the table? Make sure, that does come up. Like people want to know what you are good at and also what you are not good at. So all of these things that you would look at when you're looking at actively raising capital, these are the questions people are going to ask you. What is the strategy? What is the timeline? What's the plan for this property? And does that align with what they're looking for? That's really the reality. And again, we already talked about joint ventures. Those work great. So on the passive investment side, if you are now going to maybe want to raise capital in something a bit larger, you're going to set up a corporate structure or a GPLP or something like that. The questions often will get more technical on that side of it. So I wanted to talk a little bit about that. So again, what is passive investments? This can be a range of things, but we are going to talk about kind of the larger, more private securities in terms of GPLP, MFTs, mutual fund trusts. And what will these investors be looking for? How can you best be prepared? So number one, know your structure, know the in and out of it. You need to know your structure better than anybody else. And the paperwork can be overwhelming, even if you're just doing a kind of simple limited partnership agreement. These are pretty detailed documents. So know your documents, know what's inside of them, because you are going to get questions on them, and those questions are really important, because if you don't know the answer, then you can go back to your team and learn about it. And also you will be more prepared the next time someone asks those questions. So I love when our documents get reviewed by lawyers and other teams, because they always pick up on something that maybe I didn't pick up on. But know your documents, know what's in your structure. And what's the exit plan for it? What if things go wrong? What is included in all of your paperwork? And make sure you are aware of it. How to do due diligence on a passive investment. So what types of questions are they going to ask? They're going to ask, number one, about the who, like we talked about the structure, the security, or not. Now, we believe solely in secure investments here. And there's plenty of reasons why. We don't need to dive into that tonight, but I think people are definitely seeing the value right now, given what has come to light of why we need secure investments. But people ask us, how are they secured, right? So there's things like mortgages. In a limited partnership agreement, you are bringing in limited partners into your limited partnership, and that is their security. They are a partner inside of the company that would own the assets. So that is their security. Whereas if it's not secured, it's typically just to an individual, one-on-one. And the extra layer of security you could do there for yourself is getting a general security agreement or GSA, but even that is pretty limited. Like your recourse is pretty limited. So ideally, whenever possible, secure to a hard asset.
Well, yeah. Just to add briefly to that, I mean, I would believe that a large reason why people are driven to real estate investing is because of the security aspect. Wholly, like that is, you see the land, or if it's a development project, you can at least see the land where it's getting built. If it's something that's completed, you can go by, touch the building. It's something physical. That's what drives people to real estate investing in the first place. And for whatever reason, the variety of reasons, there's been a separation there, where there's now been a bunch of investing done in the real estate space, historically interesting because of the security, and they've removed the security out of it. So remember why you're doing this in the first place. I've said it before, I'll say it again. I'm all for high risk investments. There's a place for them. But real estate is supposed to be the secure investment, not the unsecured investment. So remember why you're there in the first place, what you're doing in the first place, why you're investing in this space in the first place. Don't give yourself the only edge, or take away your only edge of getting in this space in the first place by taking the security out of it.
Yeah, 100%. And also the security could come from another asset. So
Yeah.
you could secure a private mortgage, for example, to a different asset that that individual owns. Because some assets can't hold another mortgage on them for whatever reason. There's construction financing or whatever there is there. But that doesn't mean that there's not other assets to secure your investment against. So just having those questions ready. And I've had lots of conversations with investors who have plenty of experience raising capital, and they also kind of have a mental tally in their head of like, okay, if everything, went, sideways and I had to sell everything, I know I could pay everybody back based on the equity they have in their assets, and the security that they have provided. So if at some point that equation is no longer working, that's when you need to consider stopping and pausing and going, okay, clearly I need to shift my perspective here. I need to pivot, adapt. I need to get some advice and not just keep going with what we're doing. So having that kind of calculation in your head as to, if things were to go sideways, what would happen? And that is a question investors are asking. They'll ask me, Natasha, what is the worst case scenario right now? Or what if we get another COVID or another, unforeseen thing? Like, what is the worst case scenario? And you have to be ready to answer those questions. And answering those questions builds really good trust. It establishes some really good conversations as well, and gives you possible ideas. So don't be afraid to address those questions head on. And the nice thing about if you do have assets, worst case scenario is you can hopefully sell those assets, right? If you have income generating assets, you have income coming in. So there's, still something coming in the door should things kind of take a bit of a tumble there. So being prepared to answer those questions is a big one. And being very forthcoming with them. Like, here's the good, here's the risk, this is what could happen. References is a big one. Now, just recently are people starting to ask for references, and like, good, this is a good thing. We should be asking for references. We should be asking who an individual has dealt with before. So do have those ready. And if there is, references you've done a lot of business with, but maybe you're just new to raising capital, that's okay. As long as it's someone you have done some sort of business dealings with that can speak to their, relationship with you and their experience with you, goes a really, really long way to be able to provide some references. And I've actually loved folks asking for references because we're very happy to provide them, and we have them. And I think that's a big learning lesson happening right now as well, is that before this year, no one has ever asked me for a reference.
Absolutely.
Which is, kind of surprising when people are investing such large sums of money. Okay, so questions to ask are, from the investor side and what you might get asked. We've covered a lot of it. If there's any more that you can think of and you wouldn't know how to prepare for, let me know or make a comment. But those are the most kind of critical ones. And the number one lesson when it comes to raising capital is listening before talking. Like in sales period, I hate the word sales, but just, if you're trying to get your message across about anything, like listening is really, really important. So the first thing I always ask people about is like, what are they trying to do? What is their strategy? And also like, I want to learn about their family. I want to learn about, what they're hoping to do with this financial, freedom that they're trying to build, because it's really important for me to know that about them. It's really important for me to learn what their timelines are, what their expectations are. And the other huge lesson I've learned, and a good question to ask is, what specifically are people looking for out of the investment in terms of, equity versus cash flow even? You cannot count, or I cannot count how many times if I would have assumed that answer, I would have been wrong, because many people who have a decent income, they're in high earning point in their life, they're not looking for cash flow. In fact, they don't want cash flow. They don't want to be negative cash flow, but an investment that has good equity growth, or that is, secure long-term, that they can put in a RSP or TFSA is extremely attractive. Whereas someone who may not be in a high cash flow earning position, they may have plenty of capital sitting there, but are not at the highest earning points of their life, it does start to shift and adapt. So don't assume what the other person might want. And you can even use that if you are doing even a simple joint venture, because what you might want and what they might want, you could shift and change the agreement depending to meet everyone's goals and needs. Okay. The last thing here I want to spend a few minutes on, and that is suitability. I am going to talk about suitability as much as I possibly can this year. That's my goal for myself, because I don't hear this word enough, and I hope if I just keep bringing it up, everyone else will also keep bringing it up. So suitability is key here. If you are raising capital, you have a responsibility, and even if it's a promissory note, let's say, the kind of type of private investment or private lending that is not necessarily regulated, nowhere near to the level, say, we are, but you still have a responsibility, and securities laws still apply. They still apply. It's not the same type of reporting or any of that type of thing you have to do, but what you post on Facebook, for example, never post your returns on Facebook, like literally never. Rodney and I went to a Securities Commission like meetup thing here in Alberta. We were the only capital raisers in the room, by the way. Everyone else was like EMDs, which I was surprised by, but it was such a huge learning opportunity. So I highly recommend to get involved with your Securities Commission in your province, because I've learned a lot from them already. And they were literally like laughing about how much they see this posted online about posted returns. Now, us at WealthShare, because of our structure and because of the way we are raising capital, we can post projected returns with a link to our disclaimer and our, and our platform. But you putting a post up about a promissory note and fixed returns of 18%, no, that does not fly with Securities Commission. And I think a lot of that has been flying under the radar, but I do think we're going to see a lot more eyeballs on that type of thing. So keep those things for one-on-one conversations with investors. Don't be posting that out on social media or on Facebook, unless you are in the type of structure like we are in, where we have an exempt market dealer, we have an offering memorandum, we are the issuer, and we are allowed to do that. But that's very different than what I see a lot online. So just be really careful, because I do think we're going to see some hands getting slapped there this year from kind of what we heard there at that event. So yeah, go ahead.
Well, I was just gonna say also, like, it was kind of funny to watch them speak, but also like kind of joke, like, we're not the bad guys here. Like people are almost scared to engage with them. Like, if it's almost like kids playing hide and go seek. If I don't see them, they don't see me, kind of thing. They're gonna be there whether you want them to be or not, and they're absolutely not the bad guy. They're there to protect investors, and they're there to protect people's money. And that should be something that you're concerned about. You should be open to that and want the transparency, because if you're raising money without concern for your investors, you got to take a real hard look in the mirror at what you're doing.
Yeah, that was really eye-opening event. We'll definitely be going to more, and they were super helpful. Like, we were probably asking the dumbest questions in the room by far, because it was our first time there, and we have like so many questions, of course, being kind of newish to this space. But like that, I really felt like I could pick up the phone and call and ask a question. Like I didn't feel like I was being interrogated, or like I was going to get in trouble or something like that. It felt very like they were there to help, but also they're there to also enforce very important policies. So that was a very long-winded way to get into suitability. Yeah, go ahead. What were you going to say?
No, I'm just, that's exactly it. Suitability is Suitability is just not, it's not discussed enough. And if you're an investor or an issuer, like it should be your primary concern.
Yeah.
And if it's not, you should be asking yourself why it isn't on
Yeah.
either side, right?
So,
Like it's just
so what is suitability, right? Like, let's start there. Very basic. And you can Google all of this. We're all familiar with this. Suitability is not determined really by me or you or anybody. You do have a responsibility to have some, conversations with your investors about this, but really, it falls into two categories. There's investments suitable for accredited investors, and there are investments suited for eligible investors. And this is where I think, honestly, this kind of flexible kind of look at higher risk promissory notes, for example, this is why people have gotten into trouble. So accredited investments are secure for, or are really available because they are higher risk. And so they are open to people who have a higher net worth or a higher income. You can Google the actual definition. I'm not going to go over it. But it relates to your net worth or your financial assets or your income. And the idea is that these would be more higher risk investments, and so someone with a higher net worth or a higher financial asset base can bear a loss, right? And so if you're investing in higher risk, your risk is you could lose all of that money. That is the risk. And so, but those kind of, more higher risk investments that we've seen often, yield possibly a sexier return. And so if you are an eligible investor, this is where I think people are getting into trouble. They are then, maybe not qualifying for the higher risk, more highly regulated opportunities. And so then they are turning towards, peer-to-peer lending that offer a similar annual return is what they're hoping for. But no one is asking those questions at that point, like you would have if you were discussing this with an exempt market dealer. They wouldn't ask you about suitability or, like what would happen if you lost this entire investment, or which category do you fall in? Because really these higher risk investments, as defined by the government, are for accredited investors. So I think that's what's happening partially. I think people are going towards these kind of promissory notes, higher risk, because they might not be qualifying for the type of, riskier opportunities that they are finding out there.
Yeah, and like we've talked about before, and I'll say it again, being classified as an accredited investor is not an achievement. It's not a medal that you get that's sent in the mail or something like that. It is almost the opposite. It's now you're being assigned a higher risk ability. You are now classified as someone that can lose more. And so it's not like you've achieved something really. I think that people are not there yet. And yes, you should, of course, we all want to get to a level where we can afford to lose, of course. But it's not that now you have hit this level, you're in this club, and then you're allowed to invest in these other things. No, it's that you've achieved a level where you can lose. That's really just that's when it comes down to it. That's when it comes down to it, that's what it's about. And that's why a lot of these big issuers don't want to spend the time or the resources on issuing to eligible as well as accredited investors, because they're aware that eligible investors have a lower risk tolerance and that there is a lower pain point, and that with that comes likely more transparency and more communication, more understanding. And so they would prefer to stick to accredited investors only.
Yeah. So I definitely think that is, one thing that is happening. So if you are the one out there raising capital, like what questions should you be asking? Because this is something that's really important too. What should you be asking the other side? And there's a few things that I see as red flags sometimes when I'm talking to people that might not align with what we're offering. So, but are very common things. Number one, is around monthly payments versus annual payments, right? If someone is giving you X amount of money and they desperately, like they really need monthly payments, and I'm not to say there isn't, plenty of good investments that offer this, but there's this, like, I need this to be able to do this. That is, a concern that would bring me to ask more questions. because what if the investment goes longer? What if, there's a problem? I mean, we don't offer that anyway at WealthShare. So if someone wanted that, we couldn't offer it anyway. But if I was raising capital in that way, that would be something I would be asking, because as we're seeing in the world right now, issuers and capital raisers offering monthly payments, the problem with that for you is you have no time to adapt and pivot if something goes amok, which in real estate, there's all kinds of things that can. But again, you don't need to be all things to all people. You don't need to, offer every single thing that an investor might want. Like oftentimes people go, well, I would love if I was getting monthly payments, but I love the security at WealthShare, so I'm happy with an annual distribution. And that's what aligns with their goals and their risk tolerance. So I think these are questions we do need to be talking about when it comes to suitability, because I do think we're also going to possibly see, some bad news around that, around, the individuals raising capital. There wasn't enough care or concern taken when they were taking this investment money in. So suitability, research, learn all of those things. And if you're getting to the point where you're doing private securities, like raising capital into a limited partnership or a mutual fund trust or a private REIT like us, at that point, you are getting an exempt market dealer as well to help you with this, who is going to ensure suitability. So though they're kind of more expensive structures to set up, there's very good reason why all of that is in place. Were you going to add something there, or was that what you were going to add, Rodney?
No, that's exactly. I mean, we could go on for an hour about
yeah,
all
we
that,
could. I know, but just
and into
think
the
about
details
that.
of and into the details of why like a monthly payment it sounds great, but can be damaging to the issuer and to the business itself. And you just remember, if you're getting that monthly payment, they're paying you. So that's taking away to operating capital another way, or keeping the development or the whatever alive. So it's just, those are all important parts. But like I said, we could talk for hours about that alone.
Does anyone have any questions or comments?
Seen any pop up yet?
No, nothing.
Yeah.
Okay, I'm curious. If that is helpful. I briefly want to talk about the WealthShare offering. Obviously, we love the WealthShare offering, but I want to talk about it in a way that that is kind of ties into it, the questions I get asked. So because people often ask, well, why did you do it this way? Like, why did you do this structure? Or why do I have to go talk to the EMD? Why do I have to do these things? So I think this is really valuable kind of experience when you're going out to raise capital. Of like, because what are people going to ask about? And what else are you competing with, right? Like, what else are these investors looking at? And how do you compare? Again, not all things to all people, but in similar types of investments, what are you, being compared to? So for us, the first thing was we wanted to be open to eligible and accredited investors. We wanted to be open to as many Canadians as possible. And to do that in Canada with long-term buy and hold real estate, and then also accept registered accounts like we do, you have to have the structure that we have combined with an offering memorandum. There's no other route. It's the only route. And that's why we ended up going down the path that we did. We, had raised, capital before and done other types of partnerships and things, but we wanted to, really open this institutional kind of quality investment of multifamily real estate to not just accredited investors. Like, we really are passionate about our eligible investors. So we went, with the maximum sort of structure that would allow for that. So we get asked about that. Why did we, go down the path that we did? And that is why we wanted to be acceptable to both, because that's a big one. Opening the doors if you're raising capital and if you're doing a, corporate share structure or an LPGP, if you do not have an offering memorandum, you are, raising capital from accredited investors. That's if you're doing it right. So which may limit the pool of people you can talk to depending on your network. We also wanted to accept registered accounts. Now, registered accounts, people ask why about that too. For WealthShare, we're a long-term buy and hold. So people are in with us for a long period of time. So it makes sense that we accept registered accounts. Because we're doing annual distributions, most of our investors who have registered accounts, they're parking that money for a long time anyway, and they'd rather have it invested in real estate than whatever else they were doing at the bank. So that's why registered accounts make so much sense, because for us, it really aligns with our strategy and timeline. And then our minimum investment is kept low. This one I get asked about a lot. Now, there is kind of requirements around this if you are doing different types of structures, but for us, because we're open to eligible investors, we could set that number low. And so we get asked about that too. Well, why are you accepting minimum investment of 5,000? And I can tell you, it's because we want people to start investing earlier. It aligns with our values, and we'd also rather people dip a toe and start thinking about their, real estate investing journey if they're new to it or they're younger. We want to just appeal to as many people as possible. So that's why we did it that way. Your returns. I also go to a lot of pitches, and often people forget to say their returns, what they're targeting. So if you're talking one-on-one in a pitch session like this or a Zoom, you absolutely don't post it on Facebook. But, if you're in a conversation with people, yes, talk about your projected return. Be conservative. Be conservative, because I feel like sometimes we can feel a bit of pressure out there in the world to seriously overachieve. Be conservative, be realistic. People want right now, really, they are looking for security, looking for safe, and they're looking for a predictable return. So this also ties into a good question I get of how are you getting paid, and how are you as the issuer or capital raiser making money? Because there's all kinds of structures out there, and you need to be ready to answer this question. This is the first thing I would probably ask if we were doing some sort of deal together. So how are you getting paid as the capital raiser? Is it a portion of, equity? Is it everything is 50-50? Is it a performance bonus? Like what is it that you are offering in terms of your own payment in this? So GP LP situations, there's all kinds of splits out there. So just be ready to answer those questions, and know how you kind of compete with the other folks out there. So for us, we target a 12% annual return. So we love to aim for 12% every year, but we offer an 8% preferred return. And what that means is us as the management team do not partake in any returns unless we hit our 8% preferred return. Anything over and above that, we do get a 20% performance bonus on that year. So that's what's in it for us in the long run. And you need to be able to answer that question clearly. And I think that is worth spending time and thinking about what that looks like before you get into those conversations as well. How much you're raising. I mean, we are on a continuous raise at WealthShare, but if you are raising for a specific project, or even just a single family house or whatever, have your numbers ready to go as to what this deal requires in terms of how much money are you raising, because the answer of it depends is not enough. You need to know what this project requires if you're doing some sort of project or joint venture. And then obviously we have trust units here at WealthShare, but for you, that could be, and this is your security, right? That could be a security agreement. It could be a mortgage. It could be shares in a company or limited partnership units. So all of this kind of summarized is what people are going to ask you, and being prepared to answer those, and also just knowing it in and out is really, really key. Anything to add to that, Rodney?
No, I think you covered it.
That was good. Well, oh, Trevor is raising his hand. Yes, Trevor. Hi. Oh, wait, you're muted. Just wait, you're muted.
Yeah. How long has WealthShare been formed and operating?
Yeah, we are about 2 years old. So,
Okay.
and started out with one project and one asset, and everything kind of snowballed from there. And now, we are fully set up and ready to go. 2023 was our full kind of first full calendar year of having the entire structure set up. And we reported an 11.1% return for our first year. And we're really happy with that. So onwards from here.
Okay, great. Thanks. I might have looked a little distracted. I had 2 young kids here
Oh, that's okay.
coming out of their beds talking to me. So
Yeah.
okay, that's great.
Appreciate you tuning in with the kids around. That's always a challenge.
Sneaking out of bed.
Yeah.
I've been on since I started, and I just finished reading stories. So I didn't catch a lot of it. So you might have answered a question that I just asked.
No, that's all good.
Okay. And we're going to put the recording on the WealthShare YouTube channel as well. So if you want to read through it, I hope that was helpful. I know there's a lot of variables when it comes to raising capital. And I think that's really the message I wanted to get across. And that if you're going to go out there and raise capital, spend some money on the proper advice. Like, you cannot go wrong with that upfront. Of course, you know, the real estate investing community is so supportive, and there's plenty of people to learn from and have conversations, and what we're doing here. But the reality is I'm not a lawyer. I don't know your situation. And like, let the experts do their job. It is worth every penny you will spend on that time and energy and advice to get things set up properly in the very beginning. Okay, is that it? Just quickly, because we have, oh shoot, I just hit the wrong button. I was just going to share, if you are interested to learn more about WealthShare and what we are doing, we have our offering available on 2 EMD sites. So we're on the Atlas One site as well as the RealShare site. And you can go to their platforms. I don't know if Rodney, if you could put a link in the chat for either one of those, or if I could look it up. But if you go to wealthshare.ca, you will also find it in on our website, links to both of the exempt market dealers, as well as some information on the assets that we have. One thing to consider too, actually, this is one thing I didn't cover, is what reporting requirements, what will you be offering if you're going to be raising capital? How will your investors, you know, like, know what's going on? What are you going to provide them? Are you going to give them annual updates, quarterly updates? Like, what are you going to do to keep people up to date and informed? Because this has been a huge problem I've heard about as well, is people feel like they don't know what's going on. And I know we all get busy and life gets busy, and we do too. And we're constantly trying to improve our own communication. But at those meetings and at those updates, you need to also share what went not good. So what's going good, what's not going good, and be honest with that, because your reputation is literally everything. If you want to continue raising capital, people understand that things don't go right all the time. Like, I can't tell you, you know, how many things we've had come up that we couldn't have predicted, that the economy and changes and, you know, lenders and things that have thrown at us. But we are always honest. We tell people what has gone right and what has gone bad. I have one private investment in a tech company, and I love their CEO every month sends good, bad, like so. It's a very quick, brief email, but I know what happened that month. I feel informed. I don't need to ask any more questions. And, you know, it's not all sunshine and roses, but I feel good that he's taking care of it and things are getting done. So think about your communications as well if you're raising capital, because those first couple deals are great, but if those people don't have a good experience, or they feel really uninformed, especially if things don't go well for a little bit, that doesn't mean you can't right the ship and things can't get better, but you got to take the time to really communicate when things don't go good, and when things also go good, both.
I put the links in the chat there for both RealShare and for Atlas One. Atlas One is based out of Vancouver. RealShare is based out of Toronto. You can create an account on either of those platforms. They're both great. Both will have the offering in there, the offering memorandum, subscription agreement. The exempt market dealers will be able to have a conversation with you about suitability, the word of the day. And you know, even if you're not ready to invest, I highly suggest kind of going through the process, getting familiar with it, getting familiar with the platforms. There's other offerings on there. We know we're not meant to be everything to everyone, and hopefully we'll be a part of your investment portfolio. So there's some other great offerings that are on there, but also just the best way to get more familiar with our offering, what we've done. I think it was a great question about how new we are. We have our first year's return. So up until recently, we were able to talk about what we were hoping to do. It's been great to be now able to talk about what we've been able to do. But it's still 1 year. Now we got to go do it again next year, and then the year after that, and the year after that, right? So that's a big part of it. We're really proud of the first year in the books being really heavy in acquisition phase, but you're only as good as your last victory, really. So we got a couple one question. So Mary asked, how long does the investment need to stay in? Really, we run everything on a 5-year term. That's to maximize the return on the investment. So if you're looking at horizon, that's generally what we consider. That being said, we know things happen in life, and people's circumstances change. You can get your investment out at any point. Year 1 and to 3, there is a redemption fee that comes with taking the money out. And that's just because of the time it takes for us to put the capital to work, and because we run things on a longer horizon. But you can get your capital out at any time. There's a 90-day waiting period while we ensure the capital's there, and all those sort of things. But it's always redeemable. I just would suggest, if you're looking at anything less than 5 years, WealthShare is probably not the investment for you.
Yeah, ideally, because what's so exciting right now is year 1 to 5, 0 to 5, we're in this acquisition phase. Year 5 to 10, then we're going to start our, refinancing phase. WealthShare as a company is not going anywhere. It's not like we get to a certain point and we're done. That's not our plan. We plan to grow this portfolio, for forever. Like, there's no end game here. So of course, there'll be cycles of investors who come in and out over time, and we will be raising capital through that. We do distributions once per year right now. So whatever cash is available to distribute will be done before the end of the calendar year. And we are only doing it once per year because of how expensive it is. This is really to, ensure your bottom line, which is why, we are maybe not a good fit for someone who wants more regular distributions. It's very costly for us with our structure. So once per year. In the future, we may increase that as we grow and achieve more of a sizable portfolio. We are well over 200 investors now. I feel like we're at 250.
Yeah, we're in the 250s now.
Yeah, we're at 250 investors now in WealthShare, which is pretty cool, ranging from the entry investment to $500,000. So we will grow at the pace that we can, but our mission is really slow and steady. We are not in a race. We are not in a panic. We don't need to acquire to deliver good returns. We will acquire when things make sense, and kind of do our slow and steady wins the race strategy.
Yeah. And the last thing I'd say to that is, some of the issuers out there, they'll sit on capital before they make a decision. I can say, for one thing, that we are able to do is put your money to work the minute it is in our portfolio, because of the way we've gone about it. So there's no delay, there's no sitting and waiting. It's the moment your investment lands, that's when you start, the money starts working for you. And yes, we do offer DRIP on the cash distributions. That's a really important one, specifically for people that are interested in their RSPs and registered funds, because that way you can continue to grow your portfolio without hitting a taxable event, which if our CFO Monique was here, she would be very excited to. That's one of our value props there, is she's a very, very, very knowledgeable about the tax situation. And one of the ways we designed this was to ensure that people could have this as part of their tax planning and strategies moving forward. So yes, absolutely, DRIP is available on the investments.
Yeah.
This first year, all our growth came in the unit value, so the DRIP didn't come into play. But that's because we're year 1 on acquisition, right? Year 2, we likely will have some cash distribution, so then the DRIP will come into play then. And then moving forward, it'll be kind of a balance of unit value growth and cash distributions.
we try to target about a 3 to 4% cash distribution annually, and the remainder is made up of like your equity growth, so debt pay down, net operating income value, and growth that way. So it's a combination of the two.
Yeah. And then once we hit our 5-year, when we start hitting a refinance cycle, that balance might shift a little bit, but that's
Yeah,
for the foreseeable future. That's kind of what it's at.
Right. And then just the last note, and we're kind of over time, but the financial audit is something that, if you're looking at other issuers out there, other private passive investments, with the structure that we have, it's really an independent third-party audit that is determining how well we have done. It's not our opinion going, okay, this is what we've done. No, every dollar, cent, and penny is literally scrutinized to determine how we did that year, and they sign off as auditors. We are with Grant Thornton for that service, and it is very rigorous and intense, and it's for a very good reason, because we are, responsible for your hard-earned money, and so we are proud of that. Whereas, like we have joint venture partnerships as well. Like, of course, no one is auditing our relationship there. So again, aligning what you are looking for with the type of investment out there is really important. And there's pros and cons to all of them. And that's one thing, if you're looking for that, this type of structure will deliver that.
Yeah, absolutely. Yeah, the audit is not fun necessarily.
No,
it's
it's
not.
very detailed.
Once again, our CFO would have very many stories to share on that, especially, but it's something that we take head on, and that was actually part of our decision-making process when we went about going down this route. Is we knew full well that we would have to have audits every year, but we believe that the transparency can only increase the trust with our investors, and that we have nothing to hide behind. The bumps, the bruises, the good, the bad, and the ugly, that all comes out in the audit as well. So there's opinions, and then there's the cold, hard facts, and all of them are important.
Yeah. Awesome. I think that's a good place to stop for today. Next event will be about analyzing deals and the things that we consider when we analyze deals. Monique, our CFO, is going to do a little, screen share on all of the inputs that we use, how we, analyze best case, worst case, middle case, and really have a long-term outlook. So hopefully we'll see everybody here for that. And I hope that was of value. I hope it was, something you can take something away from and apply in your own business. And I just appreciate everybody's time.